Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're examining the Japanese yen carry trade and why its possible unwinding should be of interest to real estate investors thousands of miles away from Tokyo. Now, the carry trade sounds complicated, but the idea is pretty simple. An investor borrows money in a currency with a low interest rate and then invests that money in an asset offering higher returns. The carry trade has its roots in the economic stagnation in Japan that started in 1991. Their stock market crashed and the air came out of the real estate bubble. Over the next several years, the Japanese central bank lowered interest rates to try and stimulate the economy. By 1995, rates were at half a point, and by 1999 they were down to zero. That low cost of borrowing allowed the Japanese government to print obscene amounts of money, today over 200% of GDP. That should have resulted in hyperinflation, and so far it hasn't. That's mostly because that money stayed within Japan. 45% of those government bonds are held by the central bank, and then domestic banks hold another bunch of them. The percentage that are held internationally is extremely small. So for decades, Japan has been the natural source of cheap money. Interest rates were near zero, at times even negative. Investors could borrow yen, convert the proceeds into dollars, euros, Australian dollars, or any other currency, and purchase higher-yielding assets. Those assets might include various government bonds, corporate debt, private credit, stocks, infrastructure, mortgages, and real estate-backed securities. The borrowed money didn't always flow directly from a Japanese bank into a particular apartment development. The transition mechanism was often indirect. The funding in yen supported banks, hedge funds, insurance companies, pension funds, and other financial institutions. Those institutions then supplied liquidity to the wider credit market. The Bank for International Settlements describes the carry trade as a leveraged cross-currency position that benefits from the interest rate arbitrage and low currency volatility. The important word is leveraged. Leverage amplifies the return when the trade works, but it also amplifies the losses when exchange rates move in the wrong direction. So, suppose you borrow yen at 1% and invested in a dollar-denominated credit yielding 6%. On the surface, you earned a 5-point spread. But if you still owe yen, and if the yen rises 10% against the dollar, the interest rate spread is overwhelmed by the currency loss. And that's why the carry trade depends on three conditions. Number one, cheap funding. Number two, stable exchange rates. And number three, confidence that liquidity will remain available. All three of those conditions are now being questioned. The Bank of Japan has been moving away from the extraordinary monetary policies that made yen funding attractive, and at the same time, Japanese authorities have intervened in currency markets after extreme weakness in the yen. Even a rapid strengthening caused by intervention can force leveraged traders to reduce their positions. We saw a preview of that in August of 2024. A strengthening yen and changing expectations for Japanese interest rates helped trigger a rapid unwinding of leveraged positions. The result was not limited to foreign exchange markets. Japanese equities fell very quickly, volatility jumped, and investors sold assets elsewhere to meet margin calls and reduce the risk. So what happens to credit markets when the carry trade ends? First of all, the marginal buyer disappears. Credit markets are priced at the margin. You don't need every lender to leave. In fact, most will not. If the most aggressive buyer steps away, those remaining lenders can demand higher rates, stronger guarantees, lower leverage, and more equity. Second, assets may be sold to repay yen-denominated borrowing. The investor doesn't necessarily sell the weakest asset. They sell whatever is liquid. That could mean treasury bonds, corporate bonds, publicly traded mortgage-backed securities, or stocks. Those sales can push prices down and yields up. Now, third, volatility causes lenders to become much more defensive. A lender who's uncertain about funding costs or asset values doesn't stretch to make a new construction loan. They shorten duration, they reduce loan proceeds, they widen the spreads, and they favor established borrowers. And this is where the carry trade reaches the real estate developer. Most developers have never borrowed directly in yen, but their bank may rely on wholesale funding, and their debt fund might be financed through international capital markets. Their permanent lender may price loans from treasury yields or corporate credit spreads. Now, when global liquidity contracts, the cost of the capital rises throughout the system. A project that worked with a construction loan maybe at 7% might not work at, say, 8.5%. A permanent loan that was expected at 70% loan to value may only support 60% if the debt service coverage ratios become the limiting factor. That creates a larger equity requirement precisely when equity investors are becoming more cautious. The result is fewer transactions, lower land values, delayed construction starts, and refinancing gaps for existing investors. The issue is not that every yen-funded position will be liquidated tomorrow. Carry trades are difficult to measure because they exist through bank loans, through derivatives, through foreign exchange swaps, and off-balance sheet positions. Even the Bank of International Settlements is unable to size the market. The point here is that a source of cheap global liquidity is becoming less dependable. We're hearing about Japan selling treasuries, and even Treasury Secretary Bessent has been pleading Japan not to sell treasuries. He's aware that this is happening. So for real estate investors, this is the time to reduce dependence on optimistic refinancing assumptions. You've got to underwrite to wider spreads, lower loan proceeds, probably slower exits, and larger interest reserves. Projects should create enough genuine economic value to survive a less generous capital market. Cheap money can make a marginal project appear viable. When that money goes home, the quality of the underlying business plan is exposed. And as always, you've got to invest on fundamentals. So the Japan carry trade could be a leading indicator of what's happening in the credit markets. Something you want to pay attention to as you think about that. Have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.